Thank you everyone for attending Trend Following Trades presentation of the new TFT Ultimate V1 indicators for discretionary traders that will also be used for TFT automation during this Traders World Online Expo number 16. My name is John Carnes. I'm the owner, head trader, and educator here at Trend Following Trades. Would like to thank NinjaTrader for getting us registered, and would especially like to thank Larry Jacobs for accepting our registration and inviting us to present. Here is Trend Following Trades' U.S. government required disclaimer for your protection and a brief synopsis of what it says. Trading futures, options, or any leveraged instrument has large potential trading loss as well as large potential rewards. Do not trade with money you cannot afford to lose, which we define as trading scared money, as this will dramatically decrease your chances of successful, profitable trading. This is neither a solicitation or offer to buy or sell futures, options, or any instrument of leverage. It is important that you understand that we use historical pattern recognition as a big part of how we trade. However, past performance of any trading system or methodology is not necessarily indicative of future results. Even though you'll see real money traded here at TFT, all results are considered simulation results, and no representation is being made that any account will or is likely to achieve profit or loss similar to what is shown. Use of any kind of information is entirely at your own risk, for which Trend Following Trades LLC, its affiliates, employees, or owners will not be liable. All information exists for general educational purposes only. We are not registered trading advisors. During this presentation, I will be going over the new TFT Ultimate V1 indicator set from Trend Following Trades that can either be used on a chart, just as you see here, with a patented TFT AMA, just as you see here, or with both, as you see here. They will also be the core of the upcoming TFT automation strategies. Once we go over all the indicators and their new advanced features, we will discuss briefly how TFT will deploy automation and what we will do to help ensure its initial and long-term success. Here at Trend Following Trades, we have been trading a very visually simplistic trend following method with great success. Our visual simplicity allows for traders to make trading decisions based on an indicator and rule set that doesn't clutter up the chart with many indicators that have to come into alignment in order to take high probability trend following trades. The TFT method works the same exact way regardless if you're intraday, swing, or position trading of futures, stocks, forex, ETFs, or options on them. Although many other complicated methods have decent individual performance, often trades are missed because of having to look at so much information real time, which leads to decision lock, causing traders to miss good, valid trades, as well as feeling like they have to take lower probability trades late in the swing move. Also, not to mention what it would take from a screen real estate standpoint to monitor and trade many markets. Just so you know, we're showing NinjaTrader 7 here. We're actually in a trade. This is in Sim, and this would be typical of what you would see on a chart with the indicators by themselves. This is the latest enhanced Ultimate V1, showing some divergence. We'll go over all this. And then here we talk about the AMA. We're actually monitoring 12 markets all at one time. And all we need to do is click on these boxes here, and you can see all the different markets. Enter trades by single click execution. When you look for these highlighted blocks here, this happens to be gold, you see a block. All you got to do is click on it.
Order pending.
It puts an order in. If it executes it in, it automatically allows you to manage trades through ChartTrader, or you can use a DOM if you'd like. If you want to cancel the trade because you don't like it, you don't want to enter there, you just hit close here.
Order
and
canceled.
Cancels it out. That's just a little brief description of what's to come as we describe the AMA a little later on in the presentation. And what we've also done is we've taken the TFT Ultimate V1 indicators, and as the version before, they're used as a feed pump to feed the TFT AMA. They now will be feeding this instead of the prior version. People want to know what's different about the indicators. So let me just maximize this chart here and go over some of the difference of the indicators. Well, the TFT AMA is a patented product, and a lot of that is still intact. The indicators, again, feeding it here, but we now have completed the divergence condition block, which in the original AMA was not completed, and that are these red sticks. You'll see red, black, green. Let me pick some of a different market here that may show a little more Let's see right here. Here you go. Here's red and black. These are different conditions of divergence. Inside here, outside, top, bottom. This now is displayed in this divergence condition. As you notice, we're looking at the NQ. You have a black line here, a bar, and also colored the bottom black. The middle's white, which is here, and the top is nothing, which is blank. So now all these conditions of the chart are summarized on a row, or it's actually a saved workspace. You can have it maximized on a full chart and have the charts on another monitor, or if you only have one 1080p monitor, you can put the AMA on one half of the chart and the chart on the other half, and again flip through and see exactly what's going on. So what we're looking for, what's been added now, is wherever you see a yellow bar, and you can look at these mini charts. This is part of the patent. We look at these mini charts. These are actually viewing real market data on the right hard edge of the chart of charts that aren't even open on another monitor anywhere being displayed. But whenever you see horizontal yellow price action, it's generally an indication that the market is moving horizontally and is not really ideal to trade. You can see right now we have some pretty decent trading activity going on. In some markets we have and had some pretty flat times by these yellow bars. Those yellow bars, when our price is inside, or excuse me, our MOMO indicator, which is a hybrid momentum indicator, is inside the chop zone, it colors the price bars yellow. So we no longer have to see where momentum's at. It's automatically done by simply coloring the price bars. So if we look earlier, taking a trade in gold, we see this green block here means we're in a position long, and because this is not orange, it means it's not in profit yet. And here's our real-time P&L, and down here's our real-time open P&L, and here's our closed P&L for the day. So here we're just going to click on the euro, excuse me. You can see where we entered, and here's our stop, and here's our target. We can just manipulate this, one tick from the double top. Our stop's in a good place. We come down and get hit here. We get stopped out, no big deal. But what's really nice is when you want to enter a trade, let's look at this oil here. We don't really want to go long. We have red in the background here. We have our trigger line, which now incorporates with the AMA, has a cumulative delta volume component to it. And it's saying net short at this point in time in the swing. It's not a daily cumulative delta, it's a swing cumulative delta. So we're still technically in a buy case, but all the indicators aren't in alignment, so we're just going to stay away from it. Let's see what else lit up, and that's what we do. When we get these cells lit up, all we have to do is click on it here, and I'll do it really fast. It'll put an order in,
order pending,
and then I'm going to get out of it.
Order canceled.
Just to cancel it, so we don't have to do anything. It picks the price and everything for us. This means when it turns dark that it actually triggered there and executed in, but we cancel before then. So let's look at gold here. So gold's setting up for a short, but notice we have yellow bars. Okay. However, we were outside of the chop zone, and then we have this green bar here, which is a divergence setup to the left. But if you notice, it's an extended divergence setup. Let me just maximize this here. It's an extended divergence setup. So I don't even need to really look anymore. It goes from way back here. But what we have is a nice channel coming down. We're kind of near the top of the channel. So I'm going to go ahead and just click on gold here and put an order in.
Order pending.
And if we get triggered in, I have, I think, a 2-brick or 3-brick stop and a target down here set, something like a 2-to-1 reward to risk ratio. It'll trigger in. If not, if price keeps going back, for a better, call it back up into the upper part of the channel, it will cancel this order and it'll put it in 1 bar higher. And if price keeps backing up till it closes above this channel here, it'll cancel the order out completely altogether. Call it semi-automation. Once you click it in here, you're telling the AMA that I want to take a short. And as long as I'm below this channel and I'm in certain parameters, get me in short. The minute it breaks the channel parameters, it'll just cancel the trade. Of course, unless it's come down to meet your entry point, it'll then manage a trade according to the ATM that is chosen here ahead of time. And at that point in time, you can easily manipulate, as in the 6E right here, you can see you can easily manipulate your stops and targets any way that you choose. By the way, I'm just picking and poking here at trades just to get some dollar activity here. We're still in the green, net positive, but I by no means using filters trying to get this up to see how much I can make for this video. This order flow, what I was saying was coloring this line, this trigger line. We consider the area between this trigger line and this space in here as to be an area of value. We still do have another parallel line, if you want to call it that, dotted line, which was a stop line. It was a mathematical algorithm, line based on a mathematical algorithm. It was a lot tighter, kept our stops really, really tight. And a lot of our members, and myself included, found out that it was just kind of too tight in a lot of cases. A lot of people love it. A lot of people thought it was too tight. So what we've done is we've given you the choice to either use the channel, which is a very special channel. I'll explain to you why. Or you can use the mathematically calculated algorithm, which will hold no more than 2 Renko bricks inside of it. I just feel, and trading it now, the channel is more price-based, meaning it's coming off these swing points, these dots that are being created as the market moves. So it has far more relevance than the algorithmic type of line. Also, when you see these bars yellow, what we do is instead of plotting on one side of the channel, meaning that the market's in buy, which it is, we also plot both sides, which means that we are, along with assistance with the yellow, we are in horizontal price movement. However, we still don't lose our setups, and we still can enter and execute trades with yellow bars in the direction of the intended trade. It's just that we now look for these as support areas. So price coming down here, bouncing off here, this may be a good entry because you see some left side support coming across. The channel then becomes a support and resistance tool. And coming down in here again is another area where the tool is used. So that's an explanation of the tools. Let me just show you real quick what the complexity of some of these tools when you see what they're doing in the background, what they do for you. Okay, what I did is I took the in here I right-clicked on the chart under the indicators are active. There aren't many of them. There's actually 3 of the same one, which is the swing dot, just different time frames. But we took the Momo divergence combination indicator and we just turned on the lines that are used to calculate it, and notice all these lines. You imagine trying to trade with a chart like this? But this is the power of what's being calculated with this divergence indicator in the background. It took many, many months with 2 groups actually of C# programmers, the latest one who is our current programmer, to really decipher and program every bar, bar by bar by bar, and to draw these lines in real time and historically. The one thing about the TFT methodology, it is 100% completely back testable, which in my teachings and my own trading, if you can't back test something and you can't see and know what it's supposed to be doing, what it's supposed to have been doing, how it performed in the past, you really don't have a shot at knowing what it's going to do in the future. Even though historical pattern recognition, you really have no idea what it's going to do in the future, and you can't, base a living off of it, unknown data. But if you look at it in the past and it has a nice strong record under various different market conditions, you have a good shot of it working in the future. If it doesn't work in the past, you can pretty much be guaranteed you have no chance of having a consistent way of it working in the future. So let me just shut off all these lines, and you'll see how it cleans up the chart quite a bit. What I do is I just take this Momo divergence indicator and I say show lines, and we say false here. Okay, and then we say okay and let it redraw, and then you see all the lines are gone, except obviously the lines for the trade that I'm currently in, which is going nowhere. Time of day, time of the market, it's the euro, the 6E, and it's in the afternoon. It's actually 2 o'clock Eastern, so this is typically a very slow time. I could have gotten out here break even. Probably would have been a good idea if I wasn't making the presentation, because you notice here that this volume indicator is going net short by this indigo bar here, and if I look at it, the AMA on the 6E, you'll see that the red graph is higher than the green. Okay, so that's an indication if you're in a long position to exit. But I'm just going to let it go because I need to make the presentation here. So let's go back and look at gold, and I had a stop limit to execute me in. What it did, it actually it hasn't come down yet. It executed in here. I mean, it was put in here. It hasn't touched. It's still up in here, and it really hasn't done anything with it. So don't know if anything's going to happen with that. As a matter of fact, let me just close out here, and you can see here it hasn't executed in, or it hasn't closed up another bar. Let's leave it there. Let's see if it'll do something. It's at 1229.10. I want to come back to it and see if this price goes up more. I want to see it automatically bring price up, with a stop limit order. And if it comes down and goes through me for some reason, it'll cancel this stop limit and make it a limit order looking for a tick back. That's why we have a choice of stop limit or stop market. If I click on stop market, it'll put a stop market order in, making it, when it touches here, just making it a market order. Guaranteeing your entry, just not guaranteeing your price. Again here, now oil's coming down. The pullback into this zone here wants to get us long. We're not really interested in getting long. Volume short here. At this point in time, if I wanted to, if I would have picked this up a little earlier, higher up in the move, this market sell here is a way to manually get into the market. So right now, I want to go short in this market. Let's just say I want to go short. Okay, if you left click on this, it'll go long because it's cyan for long, indigo for short. So you say, how do I go short in a market that's saying go long? I right click on it. Okay, now I'm short in oil. And let's just bring this down a little bit. We don't need more than that really to determine if I'm right or wrong. If it comes up here for a pullback, we'll leave that there. Then we can go up here at the YM. We get a signal to go short.
Order pending.
Okay, and then not going to go into two indexes at once. It's just doubling size essentially, but let's see if the YM gets filled here. And so basically what you can do is you can trade multiple markets on one monitor and really see what's going on. When you're trading indexes, you see they're all down. Okay, the NQ's got a little positive bias to the upside, but really you can see the numbers here. This is the net change from the session open, from wherever time of day you tell it, essentially too. And then we see all this, market structure, short, middle, long term. These are the swing dots. By the way, whenever you see this orange, that means that we are in profit. That's only a couple of ticks here, but at any time I can click this orange dot. It'll pull my stop to break even. So I usually don't, would never do it a tick or two into profit. But if I have 75% of my way, I will, click on the orange to take the risk out of my trade. I don't want to turn such a big winner into a loser. And then here, this green, red, orange, and green blocks let us know that we indeed are in these markets with trades. Okay. Anytime you're in a trade, all you have to do is hit close with one of these blocks here, or down here in the lower right, this is like a global close button. You click on this button here, and it closes you out in all of the markets. Okay. So what this is used for quite a bit is when you look at your open P&L, if you have a $1,000 target for the day or something, and you add your closed P&L up to your open P&L, and you see that you're really close to it, you're right at it, often best just to close out all your positions, and this does it with a click of a button. Same goes for the stop of the day. If you're in some positions and you see you're approaching your daily stop, to not go far beyond where that is, you can hit close and just get out of everything there also. So that is describing that, and we have the trend line here. And again, all these colors are going to match. You see we have a dark green background on a chart here. We have a dark green background on this is the trend indicator, compilation of moving averages and Elliott wave theory. We're wave 3 traders, the middle third of a predicted swing move. Then we have market structure. The red dots are short, the blue dots are middle, and the black dots are long term. And then if we have a higher high or a higher low, you'll get a light green. If we have a lower low or a lower high, you'll get a light red. If you have a lower low and a lower high, you'll get a dark red. So by these colors, you can read market structure without having to look at multiple different time frames. You can look at this right here and see, in this case, the DAX. pretty much down, and you're down 250 some or 260 some ticks for the session. It's quite a bit. We're not as bad here in the U.S. session, but and you can see some of the longer term tells you that it pulled up and is actually turning back down again. So if I go to the ES, that's what you should see. You see it pulled up, and then it shows the short term turning back down again. So it's kind of neat when you get to see that real time. It gives you kind of a worldly view of the markets all on one screen or even half a screen. You can pull up to 5 AMAs if you have the hardware and the monitors to do it. It is CPU intensive, so a good i7 with a decent amount of RAM memory and multiple monitors will allow you to do that. You can purchase the futures, the Forex, and the stocks version of the AMA, or all three, so you can kind of get a look with currencies. There's a lot you can pull up to get a look at that. With stocks also, and there's something I'll show you that's part of the chart trading package, which does not include the AMA or the volume aspect of this line. We replace it with momentum, a fast momentum with the chart trader, but it does include the stocks market analyzer, which we can also put futures in there and Forex. And let me show you this in a second, and let me pull this up for a second real quick and show you what this thing does. It's really kind of neat. Okay, what you're looking at here is our market analyzer, the trend following trades market analyzer. It's a NinjaTrader market analyzer that we have embedded into it our setups on a weekly, daily, and a Renko chart. And all these charts are linked together. So when we click on a symbol, it automatically changes everything. And what it does is basically we look at a weekly symbol, we say, okay, these are weekly bars. This happens to be Procter & Gamble, PG. So we're up, Procter & Gamble here, and we're up on the daily. We broke back up above here. But since we're Renko traders, we have members that enter on daily bars, but the Renko bars really give you a nice chart look. They really keep the indicators nice and smooth. And also with the AMA, we have the same type of volume delta built into the swing you see here. So we're still positive in our volume. So the question comes up, well, how do you know what size Renko to put on any stock? We have a Renko size here. Notice how they're all different, okay? And people say, well, yeah, you put a Renko size in there, great. But now let's say the volatility. You can see here the range of this stock is very, very small here, very large here. So we have an automatic Renko setter that it's applied to every single row in this market analyzer, which, by the way, is only limited to the number of instruments whose data provider will feed. In this case, we're hooked up to Kinetic. I believe it's 100 instruments, and then you can get an option for maybe 200 or more, which is quite a bit. But what we do is we have an average true range, and then we take an average of the average true range, divide it. We have a formula where we come up with the Renko size. In this case, it's 11 ticks. So each brick here is 11 ticks. This is the white bar here is today's open. You notice we had a buy signal right here, this block here. So we had a nice winner today and still be trailing. Then we had another buy that would still be in, and then a third buy here that just triggered in. So all valid. Everything's still net long. No reason we can't take it. Let's take a look at the spiders, okay? This is an indication of the ES, so we'll just click on spiders. You see what happens. Draws a daily chart, weekly chart, and then you'll see a 11 wick Renko. Then it's going to redraw it for the proper Renko size once it goes through we call it a Renko setter. It takes a minute here the first time you do it. A few seconds, I should say, the first time you do it. And so it's 27 wick Renko for today. And you'll see here there's only a few bricks, but we had a buy signal. Let me just open this up a little bit. We had a buy signal right here, right around 8 minutes to 10, and then had some plenty time to get this filled even after news. So then we had 1, 2, 3, over almost 4 bricks of profit into it. So that's almost 100 ticks, almost a full $1 of profit in the stock. So if you're an intraday options trader, you had chances to take a trade there. If you're a swing trader, you could have taken swing trades. Let me just get out of the scale here. You could have taken swing trades back here and follow this channel, and you would still be in it for a few days, putting a stop below the low of this, these swing points here. So you probably wouldn't have got to stop that here, but you'd be moving up in this channel, or then at that point in time you can use larger time frames if you want to trail out channels. So this is something relatively new. We haven't played around with it with the futures market or the forex market, but I know that once some of our members get a hold of this, they're really going to just basically fall in love with it, because it uses multiple time frames and looks for pure alignment, if you want to use it that way, to say, okay, this is up, this is up, this is, we should be looking for longs. This is down, we should be looking for shorts. And then for AMA owners, you have the volume that you can also put into the trigger line. Otherwise, it's a momentum. The coloring of the line is based on fast momentum. So, and again, we can sort these out by, okay, let's say we're looking for buys today. We're in longs here. We're looking for buy setups. Okay, well, there don't happen to be any right now on a daily chart. So we look for in longs, and then let's just say I haven't seen this UNH. We'll just click on that and then see if there's any buy setups on the Renko chart. Okay, now I don't have enough days probably loaded in here. Yeah, there we go. So we had a buy setup here, and there's a buy setup that occurred at 5 minutes after 10 this morning. And this is a 17-wick Renko on a $91 stock. So this, we had essentially 35 cents, into this stock here. At this point in time, had you taken the long here a couple of days ago, you'd still be in it by 90, almost a couple of dollars. And for swing options traders, this is the way we look at it, because this has been in buy for a couple of days here, for many weeks here. So we may have ignored these sells. Counter trend traders may have taken them. Totally up to you. So now, last but not least, really want to talk about something that we've been waiting for almost 2 years, and that's automation, or it's basically what we call trading strategy, but in other words is called automation. Be back in 1 second. Okay, I came back. That order fill that you heard was our gold actually got triggered in here, and so we'll just stay on here and we'll watch what happens. We hit a lot of stops. You can see it took our P&L out. And again, I'm just executing trades for the purpose of showing everybody, this working in with live market data. Talking about strategy trading or automation, we really have some firm beliefs, and some of mine have changed after talking to some very serious hedge fund managers and some traders who trade big money all day long, and whose sole job is to diversify large amounts of money in trading strategies. And I've gotten pretty close to some of these people, and none of them are competitors. Matter of fact, some of them are waiting for us to finish up the automation and want to come on board with it. And I try to explain to them that our automation is more for the retail trader, from a standpoint of you must be a lifetime member, which you basically you buy the indicators, the AMA, and then you really need to understand the method, because our automation is going to be written exactly the way we trade it discretionarily. And what you see here with these Ultimate V1 indicators is about 70% of what automation is going to use. Okay, there's about 15% of it that we're not going to be showing for reasons just to make it unique, and the other 15%, quite frankly, we just couldn't code. We tried for the longest time, but it's just hard to code discretionary decision making. And but we worked a long time, and a lot of people try to convince us, when they first saw the AMA and they first saw trend following trades, hey, why don't you automate this? We know it works. Why don't you just let the computer make the decisions, take the emotion out of it. And I was for it and opposed to it, and the opposition part of it won in the end, because basically the indicators weren't ready from a mathematical coding standpoint to do what we needed them to do in order to, the automation to work successfully. Okay, but here are our firm beliefs, and there's around 6 of them, and please try to, no matter what strategy you trade or somebody tries to sell you a strategy or sell you into strategy trading, please understand these. They apply to all strategies out there, in our opinion, at least in my opinion, as owner, the head trader, and the major educator here at Trend Following Trades. I firmly believe with my heart and soul that if traders don't really understand this and believe in it, that they're just going to be giving their money away faster, because automation is all about speed and computers trading against computers. So, number one, this strategy that you're trading cannot be curve fitted or optimized with data from the last 12 months of trading. And let me explain to you what that means. Okay, what I mean is, what I've done is I've drawn a visually simplistic tool up here on the chart, which is what we're all about. Basically, it's showing 7 years worth of data. Each block, vertical block you see here, is a year. So there's 1, 2, 3, 4, 5, 6, 7. This larger one's the last year. Okay, and what a lot of people do, and too many people do, is they'll concentrate and focus on this last year. They'll write a strategy. They'll many times not tell people how it's written or what's causing it to do what it's doing. They'll sell as much of it as they can. I'll explain later why that's a big no-no. And then they'll say, okay, just run it. And then all of a sudden you'll get an arrow pop up, you'll get an order trade, you'll have a stop or a loss, and you'll have many times no idea why. And the reason you have it for the last year is because data beyond the last 6 months to a year, especially tick data, is extremely expensive. Okay? So, this is something that is a problem, because a lot of these strategies are written for scalping, and the minute you add size to scalping, as we all know, it really basically destroys the fill side of things. If any of you have ever tried to really make a living with scalping, you'll know that you do it with a couple of contracts, it's one thing. You do it with 10 or 20, it's a whole other world. The other thing is the back testing and the optimization. Okay, number one, you shouldn't be doing too much of that anyway, but doing a little bit of it is a good thing to do, because you see how well things perform. So the proper way, and you can do this in different mathematical senses, but the proper way, let's say we pick these 2 years here. Okay, now this is not cheap, okay, to do it this way, because you got to buy this data, this tick data, and quite often costs thousands of dollars per market, is to take these 4 years, all right, these 2 years, not this last year, not 3 years ago, and not 7 years ago. And you write your strategy and optimization and backtesting based on these 4 years. And hopefully you get an equity curve that looks something like this, with not too much drawdown, and not the drawdown peaks of equity, meaning the profit, you don't want to be too steep vertically, or the drawdown, you don't want to be too steep, coming down. So hopefully you get something looking like this. Maybe one's a little higher. And then you optimize here. Then what you want to see is when you run that strategy in this year, and especially the last year, without any optimization at all being done in any of these years, you want to see almost no change in equity curve geometry. Because if there is, that means that it's been too curve fitted for a certain time period, either maybe a strong up market, a weak down market, or a horizontal flat market. So really you want to try to optimize a strategy over all different market types and have it perform well in a flat market, a strong up market, a strong down market, and everything in between. So this is what they call out of sample testing, and this is in sample optimization. So you take data that's part of the market, you optimize in that data, but it's historical data. It's data that's picked randomly or intentionally because of the market type, meaning, okay, this year was a strong up market, this year was a horizontal market, this year was a weak down market, this year was all over the place. So you have various market types, and you say, okay, I want to optimize in these 4 years. Now I'm going to have a horizontal market, strong down market, and a really strong up market, this whole last year with a couple pullbacks in it, and see how it does. And like I said, you really don't want to see the geometry of the equity curve from the strategy change too much. If you get something like that and it's not a scalping strategy, which I'll get into, why scalping really from a standpoint of growing your trading size and income is very, very hard to do. You really want it to be more of a target trail type of strategy, or just even a trail type of strategy. But you don't want to see big, you really don't want to see this from the equity curve standpoint, and you don't want to see too much of, you're going to have drawdown, but you don't want to see too much of this, where you have really steep run up, really steep drawdown and run up. This is emotionally hard to deal with, and just quite frankly determines what your account needs to be able to handle historically. It doesn't tell you what it needs to be able to handle in the future. So a good rule of thumb that I've been told is any historical drawdown that you have, you should count on doubling that moving forward, just to be safe. So that's kind of what I had to say about that. Let me move on with a couple other items. Okay, another strong belief that we have is you cannot allow too much size to be traded at the same computer time, same price level, same direction, and the same market. Okay, if you do, what's going to happen? The market's going to get slipped. If you do market orders, and normally, like here, we're in gold. We have less than 25 or 30 contracts. Sometimes we have less than 5 on each side. Sometimes we have up to 20. So, basically, you take 25 contracts on each side. If I pull up a dome here, you're going to get slipped if you put a market order in on those contracts. You're going to take 2 or 3 ticks out, and you lose your fill price, your targeted fill price, which when you backtest the strategy always gets right there, and then it makes it harder to get your targeted fill price because now you need to move it further away. So you don't want to do too much size. So how do I eliminate that? Well, what you do is you control the size. You don't sell a strategy where you don't control the size. You really can't do that in the futures market, so you have to lease the strategy and have a broker trade it as a block trade. He'll have control over it, and you give members the rights, if they have rights, to trade X amount of contracts in specific markets. In this case, the AMA, we're going to have strategies written where it's going to pick the trades that come up following certain criteria, the best trades that have full alignment, room to target, all different kinds of things, historical volatility, things of that nature. And we're going to restrict size. And that's what we're going to do. Now, we have over 70 futures markets, electronic, that we can choose from. Plus, we got some big boys like the ES. We have bonds here, who at any given point in time, the bid and ask size is pretty large. And you also have some other European markets like the FVSX and some pretty big fat markets where a couple hundred contracts they won't even notice. Also, you have to look out for hedge funds that are long and short, very large positions, and they don't want people knowing, at any given point when they're unloading these positions, they need to report, but not immediately when they're doing it. So they try to find this quote dumb money. These strategies that are sold where everybody puts a limit order in, next thing you know, something in gold, you see 200 or 300 contracts at some arbitrary price, some arbitrary point in time, that can actually get filled. Well, they'll dump any size that they have right there, and no one will know who took the other side of that trade, and for a while at least, and they'll be able to get out of their position relatively unscathed, relatively unknown for a period of time. Also, reverse algorithms, computer programs, high frequency trading, all computers looking to find volume that's not hidden. Volume that's not, computers nowadays, they want to sell 5,000 contracts. They don't put in a 5,000 contract order. They do 1 or 2 contracts at a time, high speed, when they see volume that can absorb it. So that's another thing to be cognizant of, not to allow too much size to be traded, to have complete control over who's trading it, how much is being traded, and the time that it's being traded at. Another real key is a lot of companies want you to believe that you can take a computer at home, plug it in the internet, and with an automation, making a few ticks or whatever intraday, scalping, that you're going to compete with computers co-located on the exchange floor. Please don't buy into that. the execution time on computers that you can lease off the near the floor, which you can do. You can run your NinjaTrader platform down there, or have the broker run it down there, or have him run his platform down there, and you get like a 1 millisecond execution time. Versus if you do this out of your home or office with a fat pipe, what they call quote quote fat pipe, fiber optics line, and the fastest CPU and all that, you'd be lucky to get within 30 to 50 milliseconds. And even that's if you live close to the Chicago area or wherever the matching engine is for what you're trying to trade, in the centralized futures market. Okay, so if you're going to try to compete against high-speed computers, make sure that your edge lies where their edge lies, physically and with speed and hardware in an intranet, meaning in the same building, hooked up, through cables running through the same building, not in an internet where you're running over God knows what kind of distances and through how many computers your data travels before it needs to get where it's going. Remember, over 70% of volume traded today is traded by computers. So try not to think that you can beat that. Okay. Also, automation to us is something that should enhance and improve the performance of a discretionary method. All right. The worst thing that I've seen is companies selling strategies that have no real limitations built into them, as I explained before, from a size standpoint, and then taking trades with at least 70% of the knowledge as to why the trades are being taken, where they're being taken, so that you can look at that strategy and say, you know what, I know it's going to take a trade here, or I think it's going to take a trade here, or I know it's not going to take a trade here, and have an understanding why it's trading where it's trading. This way, if you have any control over it, you know how to shut it down if it's doing something wrong. It's software. Software messes up. We're dealing with electronics. Hardware messes up. There's nothing that'll ruin your account faster than a rogue computer that's decided to just trade like crazy. So only keep the minimum amount of money in your account that you need to get through double the drawdown of an worst day in the history of your strategy that you trade. So a statement like that, a lot of people will be very, very thankful of later on down the road when you're not unable to turn your strategy off. The algorithms aren't built into it where if you get some rapid price action, I know we've all seen it, the market just kind of goes nuts with price, a news release or just some computer action, and your computer's going to want to fire off all these trades, and it'll do it unless you tell it it can. Also, another advantage of having a broker running block trades from a company like us is that they're the ones that control the accounts at that point. So if they're in positions that we can't get out electronically, they can flatten it on their back end in their back office most of the time. If they can't, they should let us know so we can hedge in another account or in another market. Now we talk about trading strategies or automation with futures in a centralized market needs to be done by the broker as far as we're concerned. But we're still a little bit unsure about Forex and stocks. We want to allow stocks for sure and potentially Forex to be given to the trader. We need to find a way to secure it. When we find that way, we will try and do it. But we believe that you should be always monitoring your strategy either through Windows Remote Desktop or TeamViewer. Like I said, we're going to have a lot of protections built in for rapid price action, but you need to be able to shut it down if for some reason that doesn't. You also need to be able to get a hold of your broker. Make sure you have a good broker that's by his phone, can answer the phone. We recommend having multiple brokerage accounts where if for some reason the phones are down, cell phones, you can't get a hold of them, you have another account that's up, you hedge in that account. Meaning if you're short 3 contracts in the ES, go long 6 contracts in the YM in another account. If you're stuck in that other position, you may lock in some profit and some loss, but you're not going to flip that coin and say, well, when it opens up, I may win money, or when it opens up, I may lose money. We're not gamblers. At least we're not here. So we really believe in the multiple account approach, okay? And the purpose of, strategy trading or automation is to lose the emotion. I have worked with a lot of members and a lot of traders who in simulation can knock it out of the park. And we believe in learning in simulation. But the minute they go to real money, they make a lot of big mistakes. They start, revenge trading. they start doing things they would never do in simulation, mostly because they treated simulation like a video game and not like real money, and they just blow up their account. So maybe strategy trading is for them. As far as we're concerned, as long as it's written down that what they've been taught, what they know works for them, it's just they can't handle the emotional part of trading. Just remember one thing, unless something goes wrong, computers do what they're told. We do what we think is right, and often we're wrong, and in the market, quite often, not a lot of things make sense, things that work. So if you're going to trust a computer to do its job, let it do its job. But even computers make mistakes, and when they do, we need to go back to the human factor, and that's to save our butts. So make sure, like I said, you have a second account to hedge with. You have multiple brokers' phone numbers to dial, the trade desk, so that you can get out. And, it can be probably one of the most rewarding experiences, at least in my mind. It's a path we're going to head down and going to try to get some other people to head down, people that just can't handle the emotional part of trading in the futures market. Stocks, I see a big potential part of automatic strategy trading, automation, whatever you want to call it. In the stock market, I particularly don't like trading high leverage positions because of the single stock risk halt scenario. I've lost a couple accounts on the wrong side of stock halts back in the 1999-2000 era when they were kind of popular on warnings, and also on the other side on potential buyouts back then. And the forex markets, you're dealing with a lot of unscrupulous brokers, but there's more regulation coming into play, and these banks have big money. So it's not a centralized market where everything's exposed. A lot of it's hidden, but this is a place where automation may have a purpose outside of all the carefulness of co-location and having a broker do it and all of that. This may be a place where size may not matter because you're allowing multiple numbers of banks to take and trade your size, which will be at multiple different levels. And trust me when I tell you, they don't look at ticks; they look at tenth of ticks levels. So prices coming in at different tenth of tick sizes with different banks they won't call it dumb money. They just won't know or may not know why or where it's coming in. So I want to thank everybody, and again, especially Larry Jacobs from Traders World Online and the Traders Expert number 16. Hope everybody enjoyed this presentation. If anybody has any questions, please visit our website. It's trendfollowingtrades.com. It's right here, trendfollowingtrades.com. Don't hesitate. You can click on our contact button. Email us, call us. We are real money traders ourselves, so generally, even though here it says between 9 and 4, we support our members and potential customers generally between the hours of 1 and 7 Eastern. We don't take calls until we're finished trading, and sometimes if the days are really nice, we're not done until the market closes. So sometimes we get stopped out. Doesn't happen a lot, but it does happen. We're done for the day, and we take support calls early. So we're located between Philadelphia and New York, so we're right on the Eastern time zone, right in the thick of things, I guess you could say, in the trading world. It'd be nice if we were in the Chicago area, in the futures market, right closer to the servers, but that's not the case. So search through the website here. You can go into the home. You can find out our mission statement, some of our testimonials. We want to be the last stop on a trader's journey to success. We really put effort in, as hard as we can to work with traders and get them to realize that this, trading is a career, not something, a holy grail that you can buy. The holy grail lies within inside of us, and automation. If somebody convinces you that you can buy it to make you money, maybe you'll make some money, but are you going to make a trading career out of it and have an understanding of what trading is by spending a lot of money and buying automation that works? Which if you buy real automation that works, it will cost you a lot of money, most of which people here that are listening to this won't be able to afford. That's left for hedge funds and their own programmers. But we're trying to fill a gap where we teach people how to trade, and if they get stuck to the point where they can't make profit because of real money emotions, then we have something to offer them. And I suggest you give us a call, shoot us an email, talk to us. We have a lot more details than what you're seeing here. And hope everyone has a great day, week, and month, wherever you're at located in the world. Travel safe and good trading.